Imagine you need a loan. You walk into your local bank and they tell you no, your credit is not good enough. So where do you go? Maybe a pawn shop, maybe a payday lender, somewhere willing to take a bigger risk, but at a much higher cost. Now imagine you're not borrowing $2,000. Imagine you're a huge company that needs $500 million just to keep operating. If the banks don't want to lend to you, who does? And here's the part most people never hear about. Over the last decade, a private lending market worth more than $2 trillion has exploded in size. It isn't a secret, but it operates mostly outside the public spotlight. And regulators around the world are paying closer attention because of the risks it could pose during a major downturn. So where's all this money coming from? And if these loans start going bad, could that eventually affect the traditional banking system where your money is kept? Let's break it down. To understand this market, we need to go back to the 2008 financial crisis. Before that crisis, banks made a lot of risky loans. When many of those bets went bad, governments introduced tougher rules designed to make banks safer. Banks can still make risky loans today, but they're generally required to hold more capital and be more careful about the risks they take. That created a gap. There were still companies that wanted to borrow large amounts of money. There were still investors looking for higher returns. So someone stepped in to connect the two. Private credit funds. Think of them as lenders that operate outside the traditional banking system. They raise money from pension funds, insurance companies, wealthy investors, and other institutions. Then they lend that money directly to businesses. Simple enough. But here's the obvious question. If these banks decided that loans were too risky or simply not attractive enough, why would private lenders want them? Because higher risk usually comes with higher potential returns. If a borrower is considered riskier, lenders can often charge a higher interest rate. For years, when interest rates were very low, many investors were searching for better returns than traditional bonds could offer. Private credit became one of the fastest growing areas in finance. Companies received the funding they wanted, investors earned attractive returns, everyone looked happy, until something changed. Inflation surged. Central banks around the world raised interest rates, and suddenly borrowing became much more expensive. Imagine your monthly mortgage payment doubled almost overnight. That's similar to what many heavily indebted companies experienced. Some businesses adapted, others struggled, which leads to another question. What happens when a company can't make its interest payment? Do the lenders immediately shut them down? Not always. This is where something called payment in kind, or PIK, comes in. Don't let the name scare you. The idea is actually pretty simple. Imagine you borrow money from a friend. At the end of the month, you owe them $100 in interest, but you don't have the cash. Instead of demanding payment immediately, your friend says, "That's okay, just add the $100 to what you already owe me." You didn't pay any cash, your debt just got bigger. That's essentially how many PIK arrangements worked. Instead of paying today's interest with cash, the borrower adds that unpaid interest onto the loan balance. That doesn't automatically mean the loan is bad. Some companies use this approach temporarily while they work through a difficult period. But if it starts happening over and over, the debt keeps growing. And eventually, someone has to pay it. This is one reason some analysts and regulators are watching the market more closely, because a loan can continue to generate interest on paper even when little or no cash is actually being paid. So here's the next question. If enough borrowers run into trouble, who ends up holding that risk? At first, you might think this isn't your problem. Maybe wealthy investors lose money. Life goes on. But finance is rarely that simple. The traditional banking system and private credit are connected in several ways. For example, some commercial banks provide financing to private credit funds through lending facilities. Banks may also have relationships with the companies borrowing from these funds. And many pension funds, insurance companies, and other large institutions invest in private credit. That doesn't mean one bad loan causes the entire system to collapse, but it does mean financial stress can spread through connections that many people never see. Think of it like a neighborhood. One house catching fire doesn't destroy the whole street, but if the houses are built close together, the fire can spread until it's contained. That's why regulators have increasingly focused on how interconnected this market has become. Here's what makes private credit different. It's growing very quickly. Many of the loans aren't traded on public markets. Information can be harder for outsiders to see. And because every deal is negotiated privately, it's more difficult to know exactly how much risk exists across the entire market. That doesn't mean a financial crisis is guaranteed. Far from it. Many private credit loans perform exactly as expected, but history has shown that financial problems often build quietly before they become obvious. That's why organizations like the Financial Stability Board and other regulators have warned that the rapid growth, complexity, and interconnectedness of private credit deserves close attention. The real question isn't whether private credit is good or bad. The question is whether the financial system truly understands how much risk has accumulated and what happens if the economy slows more than expected. Because if history has taught us anything, it's that the biggest financial problems usually aren't the ones everyone is watching. They're the ones hiding in plain sight. If you enjoyed this breakdown, the next video explains the broader world of shadow banking and why it has become one of the biggest forces in modern finance. It connects directly to everything we've covered today. I'll see you there.